Welcome to our special Diwali Samavat series, where we are going to get you a lot of investment advice from experts in the field. To kick off our Diwali series, we have with us Sunil Singhania and Sailesh Bhan, the two expert equity investment managers from Reliance Mutual Fund. Gentlemen, welcome to our show. Sunil, the global environment has given us some cause for jitters. What is the in-house analysis of the global environment itself? Do you think we're going to see some more deep cuts, considering that even yesterday, after good data, the US merely lost 0.1%? That seemed to be the best it could do.
Right. At the outset, wishes to CNBC and its viewers on the festive season. I think you're right. The last 8-10 days for the global markets have been a very volatile period. However, actually what is happening is basically, there was a lot of consensus trades which were being built up. So people were short bonds, long equities, and it felt that, everything was moving in one direction. So I think it's a slight reversal of that trend. It's too early to say that, this is the start of a prolonged sort of a volatile period. Our view is that it's too early. There will be some adjustments, but it will settle down. On the flip side, I think all this is actually turning out to be positive for India, because India is exactly on the reverse. So in the last 3-4 years, the world was seeing low inflation, low interest rates. India was seeing high inflation, high interest rates. I think for the first time, the world is seeing higher inflation and higher interest rate scenario, and India, on the other hand, is looking at low inflation and low interest rate scenario. So in the near term, we'll definitely get impacted by what is happening in the world. But I think India will definitely stand out in this.
Okay. We have seen some disappointment on the government's end. I mean, people are not too happy with the fact that large-scale legislative reforms have not come through just yet. Do you expect the government to go through with some legislative reforms in the next 3 to 6 months? And what would top your agenda now?
See, again, if you see, it's been like a 5-month-old government. Yeah. In this 5 months, it's a new government. So I think after a long time, BJP has come to power. We have a new Prime Minister. Obviously, the first 2-3 months goes in settling the team. The Prime Minister has also been busy with a lot of his visits, which are also very necessary. I think what we are seeing now, we have had a reshuffle at the bureaucratic level. Our expectation is that things will pan out. But obviously, we being who we are, and as Indians, we like to see things getting done on a daily basis. And there is definitely a section of the markets, of the economy, of the industrialists who are getting a little bit restless. And our view would be that we should give at least a few more months, before we start to get really restless. Things will happen. That is what our firm belief is. And frankly, it's a matter of time. So between now to budget is a period where we need to definitely keep a track on. And if nothing happens in that period, then we definitely can get disappointment. But right now, I think it's still very early days.
Yeah, actually, quite a few FII investors we spoke to also said that they would give the government a rope, not a long rope, but some time till the budget. But the budget better contain some ideas to reset the economy. Let me get Sailesh Bhan also into the conversation. Just to tell you about Sailesh, he manages one of the largest equity funds. I think it's a 9,000 crore fund, Reliance Equity Opportunities Fund. That's not the only fund he manages. It's the largest flexi cap scheme in India, among other funds that he manages. Sailesh, what have you made of how to approach the growth story itself? As Sunil has been saying, there is a hope that growth returns. At the moment, one part of the equation is probably setting right, inflation, but the growth part is not indicating any improvement at all. Would you go with growth stocks at all, considering the kind of funds that you manage? Will you stick to the TCSs of the world?
Sure. We are coming off of a very low base, and virtually every macro variable which was against us in the last 5-6 years is turning around. I've never seen so many macro factors working favorably towards us in this kind of a short period. Yes. And minute you have this kind of a environment, if growth doesn't return now, then there is some other serious challenges in this country. So I think there's a great possibility growth returns, and growth, because there are many industries which are young. There's so much of under-penetration of opportunities here, and I think you can have years of growth return to India.
I know you guys get asked this question a lot, but I'm still going to ask you. last Diwali, the Nifty was at somewhere around 6,200. So it's a 25% growth that we've seen between last Diwali and now. What's the prognosis going forward? Do you think the markets will be higher next Diwali compared to this one?
Our view is that earnings growth can start to surprise with a lag of 1 or 2 quarters. And from our perspective, we are banking on an earnings growth of upwards of 20% for the next 5-6 years. So I think that is the basic hypothesis on what we are playing. So I don't know what the index would be in the next 1 year, but I think in the next 5 years, we are definitely looking at great returns to be made from equity markets.
But still you would have some idea of what can be gained in the first year. I mean, it's not a very near-term target. It is still a 12-month target. Does it look like 9,000 would be easy picking?
Again, we are here to create wealth or try to create wealth rather than forecast indices. But Lata, if you actually see, yes, we have seen this 25% move in the markets, but still the PE of the index is a reasonable 15.5 times. If you just take FY15 as the base year, so we are not significantly expensive. And the moment the market starts to believe that earnings can grow upwards of 15-20%, then the PE also tends to go up. And in case we have a scenario which looks very likely that interest rates might start to fall, then not only will the earnings rise, but also the PE multiple correspondingly will also rise. So I think it's a combination of a lot of factors. With some luck we can get. And I think luck is already sort of, having its blessings on India. You have crude which has fallen to like $85, and it was really, really unexpected the way it fell. And with a little bit of more luck here and there, we might see that level.
Since you're repeating the interest rate and the inflation argument so many times over, what's the breakup between, say, a fixed income investment and equity investment, at least for the next 1 year? If there is so much of a guarantee that inflation is reaching 6% in a year, is there some very easy money to be made in the fixed income side?
The allocation between fixed income and equity is so skewed against equity that, it's like 2% in equities. So I think there's a lot of room for investors to invest in equity. And what the last year has done has shown that 1 year can make for the disappointment of the last 3, 4, 5 years. So now on even a 5-year basis, funds are returning like 18-20% post-tax. And I think that is what investors are noticing. And our view is that this reaction, you would see the flows into mutual funds in fact increase manifold.
Okay. I was just going through some of the stocks that you guys have sold in the month of September from your existing portfolio, and I noticed you have a lot of oil marketing companies in that list, names like BPCL, IOC, etc. Sailesh, do you believe that the best is over for the oil marketing companies, and even if there is any policy reform, it's already been priced in?
These companies have come off, these businesses in fact, are now seeing possibly their best times in terms of, the subsidies coming down, the under recoveries reducing substantially. A reasonable amount of reforms are required here to see and capture the next level of growth here in these kind of companies. And also we have always seen when this kind of phase happens, the private refining companies do come up and gain market shares. So we need to evaluate this continuously. So there's no one directional call there, but I think we'll need to evaluate it very carefully.
Okay.
And you said about wholesale rates falling even before the Reserve Bank cuts. Actually, I think the latest debenture floated by one NBFC is at 11.75, and if we remember, all those gold companies were floating at 13% a year or two back. But you have sold those companies. Manappuram, I think, is one of the stocks you have sold. As well, you have sold MMFSL. NBFCs should not be a picking for you, or is there some valuation argument over here?
See, as a fund house and as asset managers, rebalancing of the portfolio is a daily affair.
So it gave you gains and therefore you sold?
So it's a mix of a lot of things, Obviously, there would be something which would be more sort of, you can say, attractive at that point of time. So I think with the corpus which we have to on a continuous basis maneuver, and that does not mean that we've become over bullish or bearish on that particular stock. It's more a relative call which we keep on taking.
Basically, you think NBFCs are also important picks?
They are important picks, but some NBFCs had basically the valuation had gone beyond what we felt was a fair value, and on the other hand there were stocks, Sailesh mentioned, there were some growth stocks which were not growing, but which had the potential of growing, and therefore it's an asset allocation sort of a bet. It's not that we have been very negative on the stocks you mentioned, or otherwise.
No, there could be, because for instance, the other sell that you have is the other stock you have sold is Bharat Forge, which gave just phenomenal gains. And is it a question of just screening some gains, or do you think the Mothersons and the Bharat Forges have run their course? And now with the rupee somewhat appreciating actually along with the dollar against most trading partners, the best is over for these auto anchs.
I think auto ancillary as a segment has a lot of potential. In India, the auto segment has been growing started to grow quite rapidly, and even the commercial vehicle segment is showing signs of growth, and some of these auto ancillary companies will benefit from that. Even internationally, I think auto ancillary companies in India have started to make a mark as far as exports market are concerned. Having said that, again, there are some stocks where we have large investments, and as risk measurement and rebalancing, it's always a case of trimming or buying something else. So I think you should not read too much into what we do on a daily or a monthly basis.
I wanted your view, Sailesh, on the metals sector. I was noticing that a couple of stocks that you've added to your portfolio include the likes of Nalco, Tata Steel, etc. But we are seeing some petering of demand globally, especially from China, etc. What's the view now, for the next 6 to 12 months, on how to approach the metals, both ferrous and non-ferrous?
Metals are seeing, certainly, because of the global slowdown and the China challenges which are there, they're definitely seeing a significant downturn. In fact, all prices have corrected meaningfully. In fact, possibly this is the weakest year in a long time for commodity stocks and commodity prices. Our case is, in very good quality businesses where, a threshold, like in certain segments of the market and all that, you're finding good value, right? So we are participating in those places with a 3-year kind of a view. And also stocks have started to reflect this pain meaningfully. If you look at it, all these stocks are at some significant discounts to what they were even in the last 5-7 years. So we are still significantly underweight in the sector, and we are continuously evaluating, given that a lot of these businesses are coming to value zone. So if the prognosis that global growth doesn't go into a significant challenge in the next 3-4 years, I think these businesses will recover.
So if value buying is, is something that you're looking at, how would you approach the big falls that we've seen in TCS and HCL Tech post their numbers? I mean, 6 to 8 months down the line, one could have probably thought that, it was the best time to buy these stocks when they fell post earnings. Is that your viewpoint as well, that this is a good time to be going and grabbing some of these good quality IT names?
The top tier IT businesses in India are actually very well positioned globally, in terms of the kind of market share gains they are having. And in fact, the technology shifts which are happening in international markets, whether it is, the mobility space or whether it is the cloud space and things like that, our companies are this time at the start of the wave. Unlike in earlier phases, they were not in the start of the wave. They came in later after the ERP was built and stuff like that. So I think these companies are well positioned to deliver reasonable growth over a period of time. These businesses are well positioned to deliver reasonable growth. And we are continuously evaluating as a part of our portfolio on how we are positioned in it. So today in certain pockets we are underweight. We will possibly look towards that particular sector very closely now.
Well, Sunil, Sailesh, we have to take a break on that note, but we are back with a lot more questions for our guests.